Make sure you can see me. All right, that's good. All right, good morning. Well, morning. I'm so used to trading. It's 5 o'clock. Let's start on time. I'm gonna go through the market today. I'm talking about a few basic things. And then since GME has been in the news and has been probably attracting more people to at least the stock market of what's going on with the stock market, I'm gonna tie the market into that. But I'm gonna go way back to the basics and try to approach it like somebody who doesn't know what's going on. I realized when I did my introduction video, I may have approached it in a way that that didn't take into consideration people who are like fresh to this thing entirely. So let's just start with a little bit history of the market. All right. Let's of course we're gonna start with terms of know. And the reason why I go over terms of know first is because I'm gonna be using these terms throughout the video, and you're gonna want to know what they mean, or at least have a reference of what they mean throughout the video. All right. First, we're gonna talk about market makers. This is a firm or institution that participates in the exchange at the bid and ask that it offers that it lists. All right. Hold on. Let me get settled in here. All right. So, what this means is let's take the New York Stock Exchange, NYSE, for example. All right, it is a firm. All right, it participates in. By participates in, I mean it actively buys and it actively sells, and it actively sells and buys stocks, securities, other things at the bid and ask price. All right, at the price that it lists. So not only does it actually actively buy and sell, it determines the price of the stocks. So it sets the stock at $10, or it sets the stock at $10.20. All right, and it buys and sells at that. That's what a market maker does. We'll talk a lot about market makers, so I won't stay right here too long, so we can get through this list. All right, liquidity. I've used this in past videos, and this is just a term you need to know. It's just the availability of assets, both to buy or sell. All right, and when you say something is really liquid or has liquidity, it means that you can get in terms of trading, you can get in and out of the trade really quickly, because there's a lot of either shares available, or there are a lot of people who are willing to sell or buy your shares. All right, if you're trying to sell 1,000 shares or 5,000 shares, but there's only like 3 or 4 buyers, and they're only willing to buy three or 4 or 100 shares apiece, it's not very liquid. You can't get out. All right. An IPO is initial public offering. It's the first offering of the private shares of a private company to the public. All right, so if a company goes public, like Chewy went public this last year, Airbnb went public last year. All right, so a company that wants to, and that's what's in the definition, raise capital. All right, they want to raise more money in order to conduct business at a larger scale, at a national, multinational level. All right, they'll offer shares of their company, part ownership of their company, for money. All right, and that's what happens in an IPO. All right, it's the first time it hits the stock market for the public. They usually have an offering before that for investors to get in, but for the public, it's called an IPO, an initial public offering, and that's gonna actually Robinhood is going to IPO. Is set to IPO this year. A split. All right. So this was probably in the news last year, because AT&T did a 4 to, was it 2 to 1 or 4 to 1? I can't remember. It was 2 to 1 or 4 to 1 split. Uh, not AT&T, Apple, and then Tesla. I know did a 5 to 1 split, because I bought the 5 to 1 split. All right. This is when a company divides its number of shares. All right. So a split doesn't actually make more money for the company. It doesn't do anything. All right, and you see an example. All right, if I own 4 shares of Microsoft at $4 a share, all right, that means I have $16 invested in Microsoft. If they do a 4 to 1 split, what it does is it takes each share and just multiplies it by 4, right? So uh, I will end up with 16 shares, but the price of my share, or the value of my share, will be reduced by 4, right? So I'll end up with 16 shares at $1 a share. All right, I had $16 invested, but I had 4 shares, right? And now I have 16 shares and they're worth $1. I didn't make any money. All right. When people talk about, oh yeah, and their stock split and they made all the, you don't make any money from a company splitting. All right. And the same with the reverse split. And then I'm gonna get into why companies would do these. All right, a reverse split is when a company combines its number of shares. All right, it's the opposite. For example, I own same example. I own 4 shares of Microsoft at $4 a share. If Microsoft does a reverse split, a 1-to-4 reverse split, when I wake up in the morning, I'll only own 1 share. All right, but that 1 share will be worth $16 a share. So if I wake up in the morning, I may come look at the market and be like, oh man, Microsoft is trading at $16. Yesterday it was trading at $4. I'm gonna be rich, right? I'm not gonna be rich because when I look at how many shares I have, I only have one. All right, I didn't gain any money. All right, before we talk about um, both of these, let's go down to over OTC down here at the bottom, over the counter. All right, all right. Market is a market for securities that are not listed on an exchange. All right, exchanges have requirements in order for you to be, as a company, in order for you to be traded on them. All right, for the New York Stock Exchange, one of them is your company has to be over $1 for a certain period of time. All right, if the value of your stock falls below $1 for a certain period of time, they'll issue a warning. All right, and you have to do whatever you have to do to get the value of your stock above. All right. So an easy way to get the value of your stock up is to do what's called a reverse split. All right. Because if my company's trading at 50 cent, right, and I get a warning from the New York Stock Exchange, hey, we're going to remove you from my exchange. You're not going to be able to be traded over here. You only would be traded over the counter. And I want to remain my company to remain on the exchange, I'll just do a reverse split. And if my company's trading for 50 cent per share, I can do a 3-to-1, and now my company's trading at $1.50. All right, a reverse split of a company is usually a signal that the company is failing, all right, or the company is doing bad because their shares are the value of their shares is going down, and they're consolidating them usually to stay on the exchange so they can be actively traded. All right, sometimes you'll split, like Tesla split, in order for people to get back in. At the time that Tesla split, it was probably about 25. I think it got up to 20, 25, 24, 20. I feel like it didn't get that high. $2,300. All right, $2,300 is really high for day traders to get into, or just anybody trading for $2,000 a share is really high. Apple wasn't as high. Apple was at I think $400, 440, something like that. And then of course you have everybody thought Amazon was going to do the same thing at $3,000 a share, but it didn't. But companies they'll do a split in order to attract more people to buy um, shares. All right. So when Tesla split, I think the price of it after the split, when I woke up that morning, it was like $500, right? Which is much more affordable than $2,300, $2,400, right? So that's why companies will do a split. All right. Another thing that companies will do is called a secondary offering, and this is going to come into place when I start talking about GME at the end of this. All right. Secondary offerings happen whenever hold on, let me look over here real quick. Secondary offerings happen, hey Kanisha, whenever a stock offering, it's like after the IPO. So after the IPO, right, a company may come out and they may offer 5,000, well, man, not 5,000, 5 million more shares at a certain price, right? Where you can get in. If you didn't get in for IPO, you can get in for another price. Right? There's a reason why companies do secondary offerings, and this is particular to what's going on with GME right now. All right, a clearinghouse is just a financial institution that facilitates the exchange of securities and transactions. Usually, whenever you have a broker, your broker, I'll give you a perfect example. All right, when you have an account with Robinhood, and you issue a buy order, Robinhood doesn't actually execute the buy order. All right, they send it to an exchange, and then the exchange has to send the order to a clearinghouse, and then the clearinghouse sends it back, and then you get the stock actually goes to the buyer, and then the money actually goes to the seller. All right, a few days later. All right, so the clearinghouse does all this. It's just like a middleman between the transaction to make sure that both parties are compensated. It makes sure that the buyer gets the security and that the seller gets their money. All right, you have a direct access broker. This is like not the opposite, but it's very different than what I described in the example of Robinhood. All right, a direct access broker is a broker that focuses on speed. Right, and if you watched my videos before, I said that you'll get with Robinhood and Webull and stuff like that, you'll get a bad feel, and the reason why you get a bad feel is because when you buy or sell, it sends the order somewhere else, and then the other person executes it, right? And usually they execute it at a specific exchange, all right? And I'll get into more about like Robinhood and what kind of goes on when I get to the end. But it takes a while, and that's why you get a bad feel. All right, you may buy it, and then those seconds that go by, the price moves, and you didn't buy or sell at the price you thought it bought sold it at. All right, a direct access broker allows you to execute your orders directly to the market. All right, it doesn't route them to a central trade desk. All right, let's talk about pre-agreed. A flow arrangement is basically if because Robinhood is free and Citadel Citadel market makers. Our Citadel market is the market maker that kind of is behind Robinhood. All right, they may have an agreement with someone to flow certain orders right to a certain exchange, and they may be getting paid by that exchange. Um, in this case, they probably are the ones executing on the order. All right, and so because of that, they'll let me see if I can explain this. All right, so all right, you have Nasdaq, you have NYSE, all right, and you have EdgeX. Let's just talk about those three exchanges, all right? And let's just say I'm a company, and I'm offering a free platform, just like Robinhood is, and I've made an agreement with Nasdaq that whatever order I get, I will always flow these orders to you for X amount of dollars, right? All right, that's how I make my money, all right. And so what'll happen is that whenever somebody executes an order on my platform, I don't send it to EdgeX. I don't send it to NYSE. I always send it to NASDAQ. All right. So what happens is sometimes it's slower, and sometimes you can get a worse price because NASDAQ is not offering the best price. All right. And that's what you get with a direct access broker, or you don't get with a direct access broker, is that you don't have to worry about getting filled at slower or getting filled based upon a prearranged agreement between your broker and some market maker. It goes directly to the market and gets filled at the best price. All right, a hedge fund, which has been in the market, all right, it's a partnership of investors using high risk methods to realize large capital gains. Um, and then typically there's a large capital entry price. All right, so usually to get into a hedge fund is usually hundreds of thousands of dollars just to get in. All right. As I understand it, and as I've listened to Warren Buffett talk about them, I've seen some of the performance metrics on them. They don't perform much better than actually putting your money in an S&P 500. From what I've seen, over this counter is what we talked about. All right. If you're not listed on an exchange, if I have Moody Incorporated, right, and you actually have to pay fees to be listed on an exchange, right? If I can't come up with the capital to pay the yearly fee, or for whatever reason I don't meet any of the other requirements, I can still have my company traded. It's just considered over the counter. All right. And then halts. We're going to talk about halts, and when we talk about some history of the market, all right, you have circuit breaker halts, which usually happens throughout the day. All right, this is just a temporary suspension of trading activity. It can occur because of volatility, incoming news, to fix order imbalances. All right, so recently, well, here's what usually happens. Usually, a circuit breaker halt will trigger if the price of a stock moves, like this has to be during trading hours, so pre and post market don't count. If it moves up like 10, I think it's 10% in a certain amount of time, it will trigger a halt. Okay, all right, and the reason it does that is to keep a stock from falling too significantly or going up too high. It kind of regulates the market. It keeps a stock from ballooning too much and getting overvalued too quickly, and it keeps it from dipping too much and losing too much money. All right. If any of you traded, actually, I haven't looked at the Robinhood. So if any of you traded on Robinhood or traded GME this past week, then you've seen a lot of circuit breaker halts. All right. You actually have halts that if it circuit breaker halts a lot and there's no news on it, all right, they'll do something called a T12 halt. Not T12 halt, but I think it's T3. Well, they'll halt pending news. All right. And so what they'll do is the SEC will contact the company and find out, hey, your stock is going up, going up, going up. Why? All right. The company may say, oh, well, we have a merger with another big company, and that's why. And then they'll post the news, and then the price will react to that. Sometimes they'll say we don't have we don't know why it's going up. We don't have any news on it. All right, in which case it will fall. All right. And there's a number of halts. You can always look up the halt codes. I don't know them all. I don't have them all memorized because it's like 20 or 30 of them. But you can always tell what it looks like when the stock's halted because there's nothing going on. And then there's usually, if it's halted going down, there's a whole long, the tape reads red. And then if it's halted going up, the tape's all green because people have been putting in buy orders, buy orders, buy orders. All right. All right. So let's talk about the first stock market was the Amsterdam Stock Exchange, its first exchange. I mean, you had something, you had investments before this, but this was the first one to have continuous day trading in the 17th century, which was the early 1600s. All right, they traded things called VOCs. I'm not going to get too much about the history of it. I just want to let you know that this was the first one. You had the one in Amsterdam. You had the London Stock Exchange, which is still trading today. It's the LSE. It was the first one for the whole UK, established in 1773, and it is the biggest. It was the biggest one until 19 years later. You had the New York Stock Exchange, which was established in May 1792. All right, it was the first it first was a private company. All right, and then it got acquired by Archipelago, and then it merged with Euronext. And these are just electronic trading exchanges. And the reason why electronics is significant is because usually when you think of a stock market, you think of, which is where we're gonna go and go to the next slide. You think of this, like some people have this in mind. All right, this is how it used to trade. You had people with tape, all right, bidding, and you had people asking, all right. And you had people on one side, right, yelling prices, people on another side yelling prices, all right. You had bids and you had asks. The same thing you have today is just not done by paper. You still have the bidding floor on the New York Stock Exchange. All right, this is the floor. All right. But normally what goes on down here is very large institutional trading. All right. It's not like there's no reason for me to go down here and execute an order of 1,000 shares. All right. Usually it's down here, it's like millions of shares. And then they're represented by large firms. All right. But that's some people's ideas when you talk about the market. This is not, this is part of the market. New York Stock Exchange represents the largest market maker in in the world. But this is not like the New York Stock Exchange is not the market itself, and the New York Stock Exchange floor where trading goes on is not. Though these people are traders, these do not represent all the traders, nor do they represent retail traders. All right. All right. We're gonna talk about some significant times. So market crashes. October 24th, 1929. You had the Great Depression. It was, I mean, there was a number of reasons. You had the was is refer I had it down here. You had the Roaring Twenties where there was a lot of economic growth. Okay, and so with that economic growth, people were throwing life savings and all of the money they could into the stock market, and due to that, due to the success and the growth in the 20s, and then due to the overevaluation of the success and the by erroneous speculation, I mean that they thought it was going to continue well into the 30s and so on and so forth, but it didn't. And so what happened is you had a whole bunch of people investing all this money in the stock market, making the stock prices go up because they were buying. All right, stock prices go up and up and up and up and up, and after a while, they eventually, just like, I mean, it's just like what's happening with GME. GME obviously isn't worth the $340, 340, I think it's like $330. It's not worth that much a share, right? So whenever they finally look at the company and look at the projected uh the projected value, not the projected value of the company, but how much the company will actually make, or how much the company will actually be worth. All right. And it comes back. So if the company is buying and selling at $600 a share, but then they come back and they value the company and look at its growth over the past year and say, no, it's not really worth 600. It's really more worth around 100. All right. This is going to cause a sharp drop in the price of it. And that's what happened. I had all these people that dumped their money into it based upon what happened in the 20s. And they thought it was going to be continuation, and it didn't continue. All right. It didn't continue for like 10 years. I think it was 10-year period. You had the Great Depression. All right, and that was the Great Depression. It was also called Black Thursday. You had Black Monday in 1987. And there's a bunch of I don't think they ever pinpointed one thing from the little bit I read about it. Again, I'm not a history buff. I'm just going over these little things that I've looked up. And some of these, I mean, I obviously knew the Great Depression. I knew about the Great Recession. I knew a little bit about this because I know it could happen around my birthday, or when I was born. But anyway, I just wanted to talk about portfolio insurance because portfolio insurance is what triggered really the halt, or because halts weren't always a thing because obviously there wasn't electronic um, trading, but portfolio insurance was set in place so that if the prices hit a certain level, it would trigger buying or selling. All right, and this is what happened. Portfolio insurance at that time because trading had just recently become electronic. All right. And so the insurance was set there in order to sell all of your assets if the price got too low. This is called a stop loss, all right? Which is right here. All right. So it prevents you from losing so much money, all right? But what it also did is it wouldn't allow any buying. So you had what you had was a whole bunch of portfolios protected by this insurance, all right, that would trigger sales, all right? And what happened is it would trigger the sale, the price would go lower. And when the price went lower, it would trigger other account stop losses. And you had kind of this domino effect that happened on Black Monday, which saw a sharp, you saw, I think, like the Dow Jones went down 26% in one day, which was more than it dipped in the Great Depression. I think it lost totally half of what it had made that year. But on Black Monday, it lost 26% in one day, which is the biggest loss in one day. And then 2007 through 2009, if you don't know anything about this, I always recommend people go watch The Big Short. You can learn about shorting. You can learn about the housing bubble and how it burst and how the American government bailed out um, people. Basically, I mean, it is literally just people who were making bets on bets on bets, and the American people ended up paying for these people's institutions bets, and it was terrible, terrible time. So anyway, market makers. So market makers, I've already mentioned the New York Stock Exchange. You have Nasdaq, which is the electronic exchange. The NYSE is kind of hybrid because they still do the floor, and they still and of course they have the electronic exchange. You have the LSE. We talked about that. MX is one. Citadel Securities I have to put there specifically because Citadel Securities is the one that backs Robinhood, and they do, I think, 22% of America's trading volume. So they're a pretty significant market maker. All right, and we're talking about kind of how market makers work and how they make money. All right, so they take the risk of by offering liquidity to the market by guaranteeing to buy or sell securities throughout trading sessions. All right. So, for example, if there is a buyer, and it places if a buyer is not supposed to be there, if a buyer places an order to buy 1,000 shares of FCell at the ask, all right, whatever the ask may be, a moneymaker will step in and sell those shares if it cannot be matched to a buyer. All right. So if there's me, I want to sell my 1,000 shares, all right, but there's nobody offering to I'm sorry, I'm gonna buy 1,000 shares, but there's nobody offering to sell those shares. All right, they'll come in and sell the shares that they own. All right, all right. Sometimes they take a risk because they can sell lower than what they got it at, or they can sell I mean, usually that is a risk that they sell. They get on the bad side of a trade that they have to sell at a cheaper price that they acquired the security. All right, and that's the risk that they take. That they set themselves up to guarantee to fulfill the opposite end of a bid or an ask. All right, if a buyer can't be matched, and sometimes they can do that to their own detriment. All right, because if they got FCell and they acquire FCell at $10 a share, and I'm offering to buy it at $8 a share. All right, they'll be forced to sell it to me at $8 a share. They lose $2, right? They lose $2,000 right there. All right. They make money is on what is called it's usually abbreviated MM. All right, spread, which is also the bid and ask. And then, for example, the bid and ask spread for HTZ is $4 to $4.05. All right. So if you have the bid is $4 and the ask is $4.05. All right. If the firm can execute 10,000 trades, meaning that if the money market, I'm sorry, the market makers actually set these prices. They set $4, right? They set that as the sell, and they set $4.05 as the ask. All right. All right. So if they can execute, right, meaning that people can come in and buy and sell at these prices, then they can make on this 10,000 trades $500. All right. Now they're doing much more than 10,000 because they're a market maker. All right. So they're doing, this is called high frequency trading. They're doing millions of trades a day. All right. And so that's where they're making their money. All right. They're risking this. They're risking being on the wrong side of the trade, but they're making their money on the money between the spread. So if you have a large spread, all right, which is high risk, I've seen spreads as big as $4 or $5. All right, especially on GME as of recently. All right, all right. So I wasn't going to make this video that long. I just want to talk about a few more things. I want to talk about GME, the market, and today, what's going on today. All right, so what you had happen with GME was, this is why I want to talk about the market. Let's go back to terms now. All right. So with GME, I mean, everything's in the news. You know that everybody saw. You know that um, hedge funds were shorting it. They were doing something called naked shorts too. They were shorting the stock, expecting it to go down. All right. Some people saw their position. All right, and they saw that they were able to exploit it by buying and buying and buying and buying and buying. All right. So what happened is, um, and this is actually, it's more than just buying the stock. They have to buy and hold. Okay, because when you short a position, you have to borrow the shares from someone. All right, and when you borrow the shares from someone, you usually pay them a fee. All right, so you pay the fee to them to borrow them from them, hoping to make more money than the fees, and then you have to, of course, buy the shares back to cover your position. All right. These group of Redditors, all right, Wall Street Bets, they're not, some of them are in it to make the money, but some of them are in it to send the message, all right? Because if they hold enough shares, you have to have liquidity, which is what I talked about earlier, all right? If if there are 5 million shares total, I should have wrote something else in here. There's something called the float, all right? And the float, it works, let's actually do some editing on one of these, and I'll make it make sense, all right? All right, so the float works like this. All right, if I am if I have an IPO with 5 million shares, right? I hold 2 million shares of myself. And then that means there's 3 million shares left. All right. So if I IPO, my initial public offering, right? I offer 5 million shares, whatever price. I hold 2 million shares, meaning I own 2 million myself as a company owner. All right. And 3 million shares are left. That means there are 3 million shares on the market to be bought and sold. All right. That 3 million shares is called the float. All right. If somebody comes in and shorts my stock, they don't actually have to buy them, they have to sell them. So let's just say broker, I'm sorry, broker Bob, right? At the IPO, he buys 1 million shares. That's a broker, right? Leaving 2 million shares. All right. It means there's 2 million shares on the open market. All right. And let's say Johnny, or let's say Melvin, because that's who we're talking about. And Melvin borrows 1 million shares from Bob to short. Well, let's say broker Bob. All right. So, all right. Broker Bob buys 1 million shares. All right. Because he believes in my company, or the broker believes in my company, whatever reason. All right. Melvin borrows 1 million of those shares from broker Bob. All right, to short. All right, it's only 2 million left if, let's say, Reddit owners. All right, that's what RO is. Or Reddit, yeah, Reddit owners. All right, they buy 1.5 million shares, leaving. Let's say they buy. Yeah. All right. They come in, they buy 1.5 million shares, and they hold them. They don't sell them back. All right. They hold them. All right. That's all that buying's gonna drive the price of the shares up. And if they hold them, they only leave zero point 0.5 million shares. At some point, I have to cover, especially if I bought options, because if I bought an options contract, when my options contract expires, I am required to fulfill my contract, or it can expire worthless, and I lose all my premium. All right. Usually, well, when you short, the risk is so unless they bought a bunch of puts, which I don't think they did. I think they shorted. Um, then you don't have to worry. You just lose your premium. But I think they shorted the calls. They either shorted the calls, or they just went short. And so what happened is they don't have enough money or enough shares to buy back to cover. All right, the most they can buy back is the zero point 0.5 million shares that is just going back and forth. All right, this is what the Reddit owners are trying to do to Melvin. They're trying to break Melvin. This is what actually market makers have done and this is what some people have been saying, is that it's not market manipulation, because this is what these big hedge firms have been doing the whole time. They can recognize this just like we can recognize this. We just couldn't collaborate and do it. All right. Um, and so he can't cover, so he's got to pay all these fees to broker Bob for having these outstanding shares borrowed, and he has to continue paying these fees until he goes broke. All right, and then broker Bob is eventually going to have to feel the heat of this. All right, because broker Bob has all these outstanding shares that he's eventually going to have to pay for. And this is where some of the people, like the guy from Interactive Brokers, was saying, I'm trying to protect the market and the market makers, because what will happen is somebody has, like, he just doesn't get out of the trade if nobody provides the cover for that 1.5 million, then the broker has to eat it. All right, if it's too much for the broker to eat, then whoever financed the broker has to eat it. All right, this goes up and up and up and up and up, and that's why the Reddit owners are talking about holding. It's not about buying and making money. They want to hold and break these people. All right, it's kind of similar and retributive to what happened with in 2008 when the financial institutions shorted, or not shorted, but they bet and bet and bet on during the housing bubble crisis, and we ended up eating it. All right, this is kind of like, in a way, they feel like this is payback. All right, this is the one time we, the people, kind of broke the big financial institutions. All right. So, and that's how it kind of plays into the market and what I've talked about the market today. Now, how this is going to play into Robinhood is that Robinhood, they offer you their services for free. Right now, you have to think about this. You're allowed to open an account. You're allowed to actively trade, buy, sell, short, um, and engage in options contracts for free. All right, but you have to think about all the infrastructure that goes behind that. All right, there's a reason that they offer this for free. They offer it for free because they do not actually execute any of your trades. All right, what they do is they sell your information to someone else. It's kind of like Facebook. All right, all your information. You're not really the you're not really the customer of Robinhood. You just open up an account. You're just a user of Robinhood. All right, their customer, the person, because usually you get paid by your customer. All right, if you're using something for free, you are not the customer. Let that be a notice to you. All right, they're getting paid by somebody else. That somebody else is Citadel Securities. All right, Citadel Securities is backing them. All right, so all the orders that go through um, on Robinhood go to Citadel Securities, and they execute. All right, so two things they get. Citadel Securities is a market maker. All right, So if they can recognize a lot of buying or a lot of selling, or they can analyze the data that comes through, because you got to think about the millions and millions of Robinhood users. They can look at the data and they can make judgments, make prices, make business decisions based upon the information they're getting as money maker, as market makers from Robinhood, so that they can squeeze. I mean, you got to think about, they may be squeezing a penny or two, but a penny or two out of a few million exchanges is a lot of money. All right. And these are the people who are Robinhood's customers. All right, not us. Well, not well. I still have an account, so I can say not us. All right. So, Citadel Securities is a sister company to the people who bailed out Melvin, which is Melvin in our example. Melvin represents a real person. Melvin is the manager. Hedge funds usually have a manager. Well, not usually. They do have a manager. All right. Melvin is the manager of the hedge fund, right, that lost billions of dollars. All right. And it got bailed out by Citadel. I can't remember the name of the company, but it's Citadel something. It's the same company. So they have a vested interest in him not losing any more money, because they're making money off of him, right? So what happened with Robinhood is that at some point, as I understand it, they didn't allow people to buy more shares on some day this week. All right. The reason they did that is because, again, they don't want there to be too few shares for Melvin to cover his position. Because if Melvin can't cover his position, who has to pay for it? The next person, Broker Bob, or in this case, Broker Citadel, or market maker Citadel. All right. So it keeps rolling up and up and up. At some point, somebody's going to say, somebody who's over all these people and has martial arts or capital, is going to say, all right, that's it. You're going to have to eat it. All right. And they're going to have to eat it, because eventually it will come down to the breaking of the market. And they're just not going to let the market fail. All right. So, that's kind of what happened with Robinhood. And it's going to be a little issue with Robinhood later this week, because, or later this year, because Robinhood is looking to IPO this year. All right. And there's already talks about shorting it to death, among the same people who have bought up GME. All right. Um, and then I wanted to talk about, I hope that made sense of kind of what's going on with the market, like looking at the market with what I explained and what happened with GME. They're just coming in and buying and holding. They're kind of trying to make a statement, that this generation of people have the same access to the same information and can make financial decisions, and can affect the market in the way that a large firm can do. And then they're trying to stick it to these people, the same people, because I mean, it wouldn't have made news if another hedge firm came in and did this to Melvin's company. All right, it's just that it didn't happen that way. All right, this stuff that's happening now in the media, it happens all the time between firms. We just don't hear about it because we're not associated with it in firms, because not many people have hundreds of $1,000s to sink into a hedge firm, um, in order to try to realize some capital gains. All right. So I wanted to talk a little bit about how you open up an account. I can't go through the whole thing because I already have an account with TD Ameritrade. So, but it's very simple. You would go to TD Ameritrade, and I'm already signed in, so I can show you where you go to get Thinkorswim. But you would just go here. I'm already signed in. I'm not gonna sign out because then I have to sign out back in. But you would just do open new account. You have to give it a little of your information. They're gonna ask you some questions like, do you intend to trade for other individuals? No, of course you don't. Do you work for any financial institutions? If you do, you have to answer honestly. And then based upon, like, I have a friend, she cannot trade because she's an IT specialist, but some of the computer systems she works on is used are the hardware is used for traders, for active traders, so she herself cannot participate in trading. So they'll ask you some questions like that, and then you'll finally get your account after you put. I think it's like $50 you have to put in or something like that for TD Ameritrade. I'll recommend TD Ameritrade because after you get that, you can go to trade. All right, and they have trading platforms, and their trading platform is Thinkorswim, which is what I use for day trading. So once you get that, I'll bring Thinkorswim up. All right, let's do Thinkorswim. All right, and I'm not going to bring up my actual account. I'll bring up the because when you first come here, you're going to want to play with dummy money. All right. So you see, you have a live trading, which is what's gonna be default paper money. All right. Let's see. All right, and then my numbers are gonna be a little bit different. You can reset them, um, and then you can change how much you start with. But mine is all right. So here's what'll come up. This will be your charting. Now mine I've set up because I've set up my chart, so I don't think it will come up. Let me think. I don't think it'll come up automatically like this. But you'll have access to your charts. Your level two will be over here. It'll have kind of a little dashboard over here, and then it'll have your account information over here. All right. Now, if I open this up tomorrow, actually, well, it's 30 minutes behind, so I don't know if it'll show me actually accurate data for right now. Um, but if I open this up tomorrow at 10 a.m., it would start. I could trade from it. All right, and I could pretend like I'm trading throughout the day. And this is the platform I suggest using if you're going to be actively day trading, or you want to look at some of the things I've been showing in other videos. For $50, you don't have to pay any fees after that. Is trading on here is free, so if you enter a buy order and you enter a sell order, it's going to be free to execute. Um, it's a really good platform to learn on. All right, you can draw. It has the best charts. Well, some of the best charts. I still use, even though I use another platform really to day trade on, I use these charts just because one, it has so many indicators that you can use on here, and then it's just really user friendly to use. But you can use it. It'll have all, like I said, it'll have all your information right here. So you can set this. It said I think you start with $200,000. You can set it to $20,000. You can set it to however much you plan on starting with, so that you can actually kind of replicate what you intend on doing. So you can see, oh, I'm going to lose all my money in the stock market, or oh no, I can grow my account from 2,000 to 5,000 in a month, and then so on and so forth from there. And then I can start trading with real money. And then um, what I do like about TD Ameritrade is they have a bunch of educational things. So like everything I've gone over, you can find in depth on here. From stocks, options, they talk about bonds, if you want to know about mutual funds, futures, which is just like options, but you have to buy it or sell it. Forex, they have a bunch of demos on here, and it's a really user friendly platform if you're thinking about getting more serious, more into it, and you want to move away from Robinhood, especially given what Robinhood has done um, just recently. And that's going to wrap that up. I have no questions. I'll try to do Facebook Live next week. So I hope it was a little bit informative. I hope you have a little bit better understanding of what the market is, what market makers are. Of course, this wasn't exhaustive um, like demonstration of what market makers are. I just wanted to give like a little brief history and go over some terms to know so that going forward, whenever I'm going over these things, it makes sense. And then people who are new to it can kind of have a better grasp of the foundations of what it is that we're approaching when we come in. Because before I've said, before I've said you don't sell or buy or sell to the market. You buy or sell to other people or institutions. All right, well, by institutions, I meant market makers. So you can't actually, the market maker can buy and sell something, but the market itself is not like, it's not this anymore. It's not paper trading. It's not people yelling back and forth. Um, and it's also not like a object that accepts bids and offers and then fulfills them based upon what it has. All right, it's matching you and pairing you with other people if it can, and then market makers will step in and fulfill those orders if there's no buyers or sellers to match for you. All right, that's it. I'll see you guys next week. Hopefully, I said I'll do my 2,000 small account challenge. So hopefully next week my funds clear in this broker and so I can begin trading. I'll do live trading in the morning. I'm only going to trade for a limited time. I'm going to do probably another account with it and swing trade it too. So you'll be able to see the trades live. So if I lose money, you'll be able to see me lose money. If I make money, you'll be able to see me make money. I'll explain the trades as I'm trading. All right, I'll try best to commentate and explain my thought process of why I'm getting into a trade, why I'm scaling out, why I'm getting out. All right, so I can kind of demonstrate what it is that I'm saying and what's going on, or what I've been teaching in these videos and what's going on. All right, see you guys.